Hi, Balaam Usitz here. We're going to take you through the Orchid Partners case. I'm going to take you through some ways of thinking about it and some analysis as well. Hopefully, you can use this as a learning tool to help you analyze cases in the future. As always, if you have any questions, please post them to the forum. So, one of the first set of questions you want to ask yourself is, does Orchid Partners meet the criteria for a good business opportunity? After all, that's what Todd is trying to figure out, right? The whole case revolves around Todd and him trying to figure out should he join or be part of Orchid Partners. So one thing you always have to ask yourself the question of is that does the team have the necessary skills? So team is very, very important. You want to make sure, just like any team, let's use a sports analogy here, like baseball, you need one first baseman, you need one second baseman, you need one right fielder. You may need a few pitchers, but other than that, you only need one person in each position. So business is very similar to that. Do they have all of the skills necessary to run a venture fund? The next thing you want to ask yourself the question is the market environment. So is it a good time to be investing? What's going on in the broader venture capital space? Remember, starting a venture fund is like starting any other business. They have to find limited partners to invest in Orchid Partners. So you need to find investors. Is the environment good for finding investors right now? So that's a big question. Right now, at the time of the case, the VC industry seems to be in a little bit of a flux. So it's unclear whether it's a good time to invest or not. And if the market is down, then it's going to be harder to find limited partners to invest within Orchid. The next question is, are there good quality investable companies? Here again, this is hard to tell from the case itself, but it appears that there's not a lot of people investing in seed stage companies, which would tell you that there might be a lot of companies to pick from, and in general, choice is good. The real important question, though, is if you're investing today, what will the mergers and acquisitions market look like, or the IPO market look like 3 to 5 years from now when you want to exit those investments and harvest the cash? So that's always an unknown, very difficult to figure out, but also exceptionally important. The other question you always want to ask in any business is what the competition is like. How many other VCs are playing in this space, not just in seed stage investing, but what industrial sectors does Orchid want to invest in? So there's a long list of questions you want to ask yourself, and we're going to go through some of these a little bit in the future slides here to help you think about them. For now, let's just focus in on Todd. What skills does Todd bring to the table? Has he ever invested before? Does he know what it's like to invest? He raised venture capital money back when he was at Staples and some other companies, so he's a successful entrepreneur, so that's often good. So being a successful entrepreneur is a good skill, and you'll see that many venture capitalists began their careers as entrepreneurs. So that's a reasonable thing to bring. So he brings some good skills. He also, I think, brings a lot of good operating skills, which is very good for any company. So he can help companies grow, right? Because one of the things an investor wants to do besides writing a check is they want to be able to help companies grow, give them advice and counsel. They're typically going to sit on the board of directors. So what's the underlying fact here that I think you really want to think about a little bit is what's his motivation for becoming part of a venture fund? I think if you read the case, it says he wants to spend more time with his family, and he doesn't want to work the long, arduous, hard hours that he has in the past. So, does more family time equal startup? Right? And that's a question you have to ask yourself in any startup, right? In essence, Orchid Partners is a startup. And usually in startups, you're spending tons and tons of time at work, just getting the thing going and trying to build a successful business. So I think we really need to ask ourselves a question, is Todd's view of doing this realistic? Is he doing it for the right reasons? So one of the questions in the case is, should the partners close on and start operating the fund even if they don't meet their target size? So as many things in many cases, there is no right or wrong answer. So how you think about this is the much more important thing than whether saying yes or no to any of the questions asked in any of these cases. So we really have to ask ourselves the question, what are the implications of closing early? And given the number of general partners they're going to have in Orchid, how big does the fund need to be to have sufficient annual fee to run the business? And how are they going to operate and think about the business? So in order to do that, on the next slide, we're going to go through a little bit of analysis. So let's take a look at some numbers just to kind of give you something to think about. So let's assume they're going to raise an $100 million fund, and that's going to have the typical 2% fee and a 20% carry. So the way the fee works is that's the money used to operate the fund and pay the general partners. So 2% of $100 million is $2 million, and that's paid for the life of the fund, which is typically 10 years. So 2% of $100 million for 10 years basically is $20 million. So what that means is your investable capital that you have left is $80 million. So even though you raise a $100 million fund, you only have $80 million to invest. So that's important to know. And they talk about an initial investment size of somewhere between $500,000 and $1 million, with up to $10 million follow-on investments in well-performing companies. So okay, so those are two good facts to know. Now they have 5 partners, and assume that each partner makes 2 investments each for the first 4 years. So if there's 5 partners and each of them makes 2 investments a year, that's 10 investments a year, 4 years, that's 40 investments. So they're going to invest in 40 different companies. And let's just assume for discussion purposes that they invest $1 million in each of those companies. Okay, so 40 investments, $1 million each. That means of the $80 million they have to invest, $40 million they've done in initial investments, and they have $40 million left for follow-on investments. So how are you thinking about it so far? Well, the question here is, let's say that of those 40 investments, half of them are a flop, right? Which is pretty typical for seed stage investing. So that means you have 20 investments left. So 20 investments will need follow-on capital. Well, that only leaves $2 million for each of these investments as follow-on capital. Even if you only had 10 investments left, that would only be $4 million each in follow-on capital, which is far outside the parameters, excuse me, far outside the parameters that they were thinking about. So what are some of the variables that they can play with? They can either think about raising more money, okay, or they can think about fewer partners, right? Because at 5 partners, that's a lot of general partners. And so I think in this case, even at $100 million, you need to sort of question yourself, does the structure and the logistics and the financial planning really work to make this investment or to make starting the fund worthwhile? So let's just look at a couple conclusions here. Number one, first thing we looked at is Todd. Why is he joining? Does he have the right skills? And we can really go through that type of analysis for each of the other 4 partners as well. The other thing that we looked at is sort of the financial projections and just trying to understand that a $100 million fund with a 2% carry really only means you have $80 million to invest, and is there enough capital? And thirdly, I want to just point out that there is no right or wrong answer here. What's important in these cases is how you think about it and how you analyze it. So hopefully you've learned a little bit about that from this. And it really doesn't, again, there's no right or wrong answer. There's plenty of funds that are successful, have 5 partners and are smaller than $100 million. And there's, two-person funds that raise $500 million. So there is no right or wrong answer. I just want you to use this as a helpful hint in moving forward with some of your follow-on case analyses. Again, if you have any questions, please post them to the forum for the course, or as any comments, please post them there as well. Thanks again, and see you in class soon.